Before I get into this, I'm going to ask you to settle in and pay close attention because there are a lot of details here and it's easy to lose pieces. There's quite a bit going on, so just keep that in mind. Anyway, when we're determining our taxable income and income tax, the first place we have to start with is how much money you actually happen to have. Where you start with the idea of gross income, which is the amount of money that you just have coming in overall. That's the amount you make, that's your salary before anything else gets discounted, anything else gets added. From there, you can talk about what's called your adjustments, where your adjustments are things that you may be paying or that you may get back that don't get included in taxes. For example, alimony payments, student loan interest, and certain retirement contributions don't get taxed, so you can immediately throw those out before doing much of anything else. And by the way, when we're talking about gross income, we're not just necessarily talking about the money you get from your job. This can also include things like winnings on certain game shows, although whether that's considered a gift or income is actually a very important gray area that we're not going to get into very much in here. But when you have your adjustments and your gross income, you can make what's called your adjusted gross income, which is just your gross income minus the adjustments. So far, so good? Okay, we're moving on to the next part. Then from there, you can get into what's called your taxable income, where your taxable income will consist of your AGI, adjusted gross income, minus the sum of your exemptions and deductions. Now, why they call these things separate, I'm not entirely sure. It's a categorization thing, and the IRS likes to be very categorizable, where exemptions are fixed amounts on your return that are determined by the number of people your income supports. These are things like your dependents, where the more you have, the more people that your income is covering, the more you can take out there, while deductions are specific things that you can take out from that as well, going towards things like state income taxes if you pay those, property taxes, and certain large medical expenses.
Save all the receipts because anything you buy for the store is a write-off.
That's not a write-off. That's not a write-off. This? Not a write-off. A write-off is a business expense used to reduce your taxable income.
Okay, well then why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Where, depending on your circumstances, you might take what is called the standard deduction. It's usually what young people like you who are watching this end up taking, because it's often going to be a lot more than your itemized deductions, because for young people, you tend not to have very much in the way of itemized deductions because you're not paying a great deal of income tax to your state, especially not here. You probably don't own property, and usually, even if you're paying for your own medical bills, they're not going to be that expensive just yet. Hi from the editing room. So as of the Tax Cuts and Jobs Act of 2017, that is the 2018 tax year, the personal exemption kind of got folded into the standard deduction, so it made the standard deduction worth a lot more, but you also have that weird gray area there with the exemptions, and it means that the book is out of date, so sorry, but we're going to have to pretend that we're still living in the year 2017 working on these examples. It'd be nice if they were more applicable to our everyday lives, but maybe they will be again in 2025 when the law changes in whatever way it may change. In any case, sorry, there's a bit of a discrepancy there, had to mention it. Back to the rest of the video. But you can take that itemized if you prefer. In any case, once you get your adjusted gross income, subtract the exemptions and deductions, which usually isn't going to be as complicated as it sounds if you take the standard and the one for just yourself. That's how you get your taxable income. And then once you fall into determining your taxable income, then you can start looking at the brackets, where the brackets are broken down by tax rate for the amount of money you're making and your filing status. Your filing status can either be unmarried, divorced, legally separated, that is, you are single, or married but filing separately, where each of you is filing your own tax return for various reasons. It might be because it's more inexpensive, it might be for some other specific circumstances that I wouldn't know very much about because I'm not currently married. And otherwise, if you're married but filing jointly, or if you are filing specifically as the head of a household, like if you are married with kids and you are listing those kids specifically as your dependents to be supported by your income, where the amount you pay goes in branches, 10%, 15%, 25, 28, 33, and 35, depending again on how much you are making, how much your taxable income is. And then you have the standard deductions, which, as you see, change depending on how you file, and the exemptions for the number of people that you are filing as supported by your income, where we have what is called a progressive tax system. That is to say, you're not paying all of your money based on the bracket you fall into, you're only paying for the amount that you are in that bracket for. So for example, if you end up making $389,000, you would only, and you are filing as a single person with minimal dependents and all that stuff, you would only be paying the 35% tax rate for the $650 that is specifically in that bracket. Everything else would fall into the other brackets below, which has this sort of dominoes chain that we're going to see later, but we're still not quite done. The last thing we have to look at are what are called tax credits. These get accounted for at the very end and generally come from things like government-supported programs for where they want you to do some specific thing. For example, we have, as of 2009, I believe it's still in effect for this and next year, what is called the American Opportunity Credit, which is available to students who are at least half enrolled in American universities, where you can get up to $2,500 in tax support, where that's either going towards the amount you're paying, that is, you pay up to $2,500 less, or you can actually have up to $1,000 just added directly to your return at the end of the process, if that is applicable as well. But finally, the amount you pay in income tax after all of these parts is simply the computed value of all of your taxes after going through everything else minus whatever credits may apply for your circumstances. And to be clear, this is complicated. Part of that is very much intentional, and part of that is very benevolent, for the fact that in our system we want to be able to tailor our tax code to fit the specific needs of each person or each family filing. So you want to build in as many chances for people to either pay a little bit less or a little bit more depending on what it is that they are doing with their everyday life. And also there are a lot of people in legislative positions who use things with the taxes to get certain pieces of legislation through, and as a result we get these tiny exceptions and these large exceptions and these deductions that get built in from time to time and complicate the mess. Usually the point of this is to ultimately make the experience in terms of the amount of money you're paying better for the average person, but if you'll allow me to put on my conspiracy hat for 1 second, there are certain people in power, whether that be local, state, federal, what have you, who have motivations to make our tax system look as Byzantine and complicated and generally just unhelpful as they possibly can. These are personal, financial, ideological, and so on motivations.
It's never too early to learn that the government is a greedy piglet that suckles on a taxpayer's teat until they have sore, chapped nipples.
But point is, they have reasons to make taxes look bad, so they do what they can to make them look bad. Anyway, main thing we gotta do in this section, main thing we're working towards is seeing how this works all together in the practice, of some examples.